This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In the previous 3 chapters on the unincorporated trader, we have focused on, in Chapter 4, the adjustment of profits. Now, I hope you recall that is how we took the accounting profit, our bottom line accounting net profit as per the statement of profit or loss, and made it acceptable for taxation purposes. That was a process of adding back any expenses or items not allowable for taxation and deducting anything that was not taxable as a trading profit. That gave us the adjusted trading profit. Now, of course, one of the adjustments, and adjustments no doubt that we'll remember until our dying day, is that depreciation is not an allowable expense and therefore it is added back. And what replaces it is what we saw in Chapter 5, capital allowances. What do they represent? They represent the way in which HMRC give tax relief for capital expenditure incurred. And depending on the type of plant and machinery acquired and when we acquire it, we were able to establish the levels of AIA, WDA or FYA that may be claimed in relation to an accounting period. Chapter 4, Chapter 5 looked at the determination of the tax-adjusted trading profit of the taxpayer's chosen accounting period. As we know, the taxpayer can choose any accounting period end date that they wish to make up their accounts to. And for that period, we adjusted up the statement of profit or loss and we computed and deducted capital allowances. And so it was in the previous chapter that we then saw in Chapter 6 how we would relate that tax-adjusted trading profit of the accounting period to the tax year in which that profit would be assessed. We looked at our bases of assessment in Chapter 6. Now there, as we saw, for a normal ongoing business, we would use CYB, current year basis. Simple enough that in any tax year of assessment, for us, notably the 2015-16 tax year, for any tax year of assessment, we would assess the tax-adjusted trading profit of the accounting year ended in the current tax year. Ended in the current tax year. That was fine as long as you had an ongoing business. But of course what we saw, there were very specific rules by which we would determine assessments in firstly, and probably most awkwardly, the most difficult one to deal with, the opening years of a new unincorporated trade, where we went from an actual basis in the very first tax year to a CYB as soon as we possibly could. That might have been as quick as the second year, more likely the third year, though in certain circumstances we may have to wait until the fourth tax year before we're able to utilise CYB. Now we then stick with that basis of assessment until we came through to, and we use it up to and including the penultimate tax year. With the final tax year, we then needed to assess any and all other remaining profit as yet unassessed. So our technique in the closing years was simple enough. Look at the date of cessation, that tells you what is the final tax year. Leave it, go back to the penultimate tax year and assess using CYB. Any and all remaining profit, that would be either 1 or 2 periods of profit to now include, those profits, less any overlap relief, our overlap profits from opening years, would be deducted in giving us the assessment in that final tax year. But up until now, it's all been about profit. But of course, not all businesses in every period will make profits. And so it is now in Chapter 7 that we look at what happens where the business sustains a tax-adjusted trading loss. If, as the HMRC are going to do, they're going to tax us on profits, then, again, each coin has 2 sides, they must give us relief for the losses that we sustain. So in Chapter 7, we look at the various loss reliefs available. So I need you now, therefore, to turn in your notes, if you haven't already, to Chapter 7. And we will pick it up from here. Right, first thing we need to know in terms of when we sustain a trading loss If the basis period has a trading loss, here I'll note if the basis period has a trading loss, so we're looking at a given accounting period, we've adjusted the profits, we've computed and deducted the capital allowances, and what we've got is a tax adjusted trading loss instead of a profit. Well, what assessment does that give rise to within the income tax computation? We don't put a bracketed, a negative figure into the income tax computation. Instead, the assessment in the income tax computation is nil. So wherever losses are sustained, and this is true in income tax, it's true in corporate tax, and it's true whether it's a trading loss or any other type of loss. If we sustain a loss, the assessment in the computation, here income tax computation, later corporate tax computation, the assessment is nil. We do not put a negative, a bracketed figure onto the computation. And having put that nil assessment onto the computation, what we must then do is to look at the available loss reliefs. So the loss, relieving that loss, the loss may be relieved according to the following rules. Now what that may lead to, if as we're able with certain of the loss reliefs to carry back the loss sustained in the current tax year to an earlier tax year, the effect of which is to reduce the income of that earlier year. Now, by this point in time, we will already have paid the tax for an earlier tax year. How and when we pay tax is a later chapter, but now in a later tax year, by this time we will have paid the tax for an earlier tax year, and we're now going back and using a loss to reduce the income of that earlier year. Well, that therefore changes that income. It may indeed totally eliminate that income, meaning that we will have overpaid the tax for the earlier year, and hence a repayment of income tax may result in some circumstances. Now I say some circumstances, this is only be where we're able to carry a loss back. Now we've got to look at certain basic loss reliefs here, certain basic loss reliefs. There are many different loss reliefs. Most of them, not all of them, however, are contained within the F6 syllabus. So what are now in section 2 here the reliefs available? Well, the easiest of them, the simplest to apply, is having got your tax adjusted trading loss, put your nil assessment into your income tax computation of this year. We then carry forward that loss to set off against just one thing: future trading profits of the same trade. Carry forward against future trading profits of the same trade. Now that is a very simple loss to apply, as we see here in section 3. Carried forward and set against the first trading profit, so it's the next available trading profits from the same trade. So when you carry forward, you must set off that loss in full against the next available trading profit. You cannot say in any future tax year, oh, this profit for this year is so small, I don't think I'll bother using up that brought forward loss from the earlier year. You do not have that option. When a trading loss is carried forward, it will be set off against the next available future trading profit of the same trade. Once you've carried it forward 1 year, any loss remaining continues to be carried forward until further profits arise and until, of course, that loss is used up. The loss is carried forward indefinitely so far as you're concerned. As long as the business continues to trade, the loss will continue to be carried forward. One hopes, of course, that it is a short-lived carry forward because you're back to making profits. However, those are the basic conditions that you need to know. So very, very simple. Carry forward against the future trading profits of the same trade. Now we said there about how we determine the assessment for any tax year. So let's just go back and make a little note, have a little example of what goes on here. Right, if for example I told you that we had as a business, a sole trader, or indeed as we'll see in the next chapter, a partnership, we had prepared accounts to the year ended the 30th of June. And for the year ended 30th of June 15, we sustained at a tax-adjusted trading loss of £40,000. Right, what do we know now that we would do with this? Well, this is an ongoing business that has made a loss for the year ended 30th of June 15. So, using a current year basis of assessment, in which tax year would we have assessed the tax-adjusted trading profit of the year ended 30th of June 15? Well, I would hope indeed that we're all shouting out now. Well, clearly, the year ended 30th of June 15, that date ends in the 15-16 tax year. So that is the basis period for the 15-16 tax year. And because we've made a loss, whether the loss as here is 40,000, 4,000 or any other number, the assessment is nil. What does that mean? It means that when you do the income tax computation, as we looked at back, if you remember now, back in chapter 2, all those hours ago, back in chapter 2, we prepare the income tax computation for a tax year, 15-16. Then on that, you would list out trading income nil. You do not put in the bracketed £40,000. What would we then do with that? Well, with our carry forward relief, that would carry forward against future trading profits there of that same trade. So we would firstly go against the trading profit. Well, what would be the next available trading profit? Well, that, of course, would be, if this was 15-16, we'd carry it forward to 16-17, where, given that we've made up accounts to the year ended 30th of June, hopefully for that next accounting period, the year ended the 30th of June 16, there may be a trading profit, and you would put that loss against that profit. So if, for example, the profit for that period was £60,000, you would then deduct the loss brought forward, and all of that 40,000 would be used, leaving you with a £20,000 assessment to include within your income tax computation. You'd have a 20,000 net after loss brought forward, a 20,000 net assessment. If, on the other hand, the the tax-adjusted trading profit, I beg your pardon there, if the tax-adjusted trading profit was, say, £20,000, and you have a loss brought forward of 40, you would remove all of that 20,000, and what would it leave you still with? A carry forward of the unrelieved 20,000 loss against the next available future trading profit. If that was for the year ended 30th of June 17, then that would be relieved in 17-18. So it's a simple relief to apply. Carry forward against the next available trading profit, and it goes only against that trading profit. On the income tax computation, you deduct it directly from the trading profit. Now, in any exam question, what we're more likely to see is, shall we call it, a more interesting loss relief exercise. And that would then come down to, for a normal ongoing business, relief now, here in, again, section 2, but part B of this, relief against total income. Now, here's an immediate change. The carry forward relief was very specifically trading profits. Only one figure, future trading profits of the same trade. In this, the second of the reliefs we need to know about, relief is against total income. Now remind yourself what that total income was. That was your earned income plus, of course, then your unearned income gave you total income. And we said at the time when we looked at that in chapter 2 in our income tax computation that there were certain deductions that would be taken away from total income to give you net income. Those deductions were qualifying loan interest payments, which, as we'll see in a moment, would still be the first deduction to apply in any such tax year. But then we said certain loss reliefs. Now we are seeing what that certain loss relief is. Relief against total income of the current and or preceding tax year. the current and or preceding tax year. So how would we deal with this one? Let's go back to that example that we have running, where we saw that for the year ended the 30th of June 15, that we had a loss, adjusted for taxation purposes, of £40,000. That gave rise to an assessment in 15/16 of nil. This relief that we're now looking at allows us to set off against the total income of the current tax year, well, we know what that is, 15/16, and or the preceding tax year, which must be, of course, 14/15. So here, let's just identify our current and preceding year relief. So with these reliefs, current stroke preceding tax year relief. Now, if you merely have to advise on what the possible uses are, having seen, as we've just shown up here, that the loss was of the year ended the 30th of June 15, you've got an easy narrative statement to earn your marks. The statement would say that the earliest relief available would be to set off against the total income, we'll write that in a moment, of the current tax year, 15/16, and or the preceding tax year, which must be 14/15. So let's just make a note of what that is. Set off against, we target total income of current tax year. What is the current tax year? It is 15/16, and or the preceding tax year. So here you have a choice. You can set off in the current tax year alone, you can set off in the current tax year and then the preceding tax year, or you could set off, if you want, only in the preceding tax year, and then if you wish to, you could follow that by a current tax year claim. You set the order of these claims. Total income of current tax year, 15/16, and or the preceding tax year, which therefore must be 14/15. Now we note that it goes against the total income. The total income. Now total income, as we have said, is going to be before any deductions apply against that total income in the form of the qualifying interest payments and the loss reliefs. As I've said, and we'll see in our notes in a moment, any qualifying loan interest payments, should there be any, probably not likely that there will, but if there were any, they would be deducted first and then the loss. Now that would bring you down to net income. But remember, net income is also before a most important deduction on the face of that income tax computation. That net income is before the deduction of the personal allowance. And herein lies one of your main problems about the application of these loss reliefs here. They target total income. Total income is before the deduction of the personal allowance. And these loss reliefs cannot be limited. You cannot make partial claims. You cannot pick and choose how much of your loss you will put against the total income. If your loss is bigger than the total income, then the claim that you make will remove all of that total income. And if it does, if that loss claim reduces the total income down to nil, think of the effect of that. It means there will now be nothing to deduct your personal allowance from, i.e., we will have wasted the personal allowance. And that's a significant and important planning issue when it comes to you in a question advising a client about which loss reliefs firstly are available, but secondly, and maybe more importantly, which of those loss reliefs may be the most worthwhile. The problem with these reliefs against total income is that total income is before the deduction of the personal allowance, you cannot make partial claims. The loss must be used in full against however much total income exists for that year, which means if you bring the total income down to nil or merely below the level of the personal allowance of, for our year, £10,600, then you will be wasting some or all of the personal allowance. Remember that a personal allowance, if unused in part or in full, then the unused part is wasted. You can't carry forward an unused personal allowance. With personal allowances, remember, the idea was use it or lose it. So here we have a problem as regards the application of this particular relief. Okay, let's just return to our notes and look at some more of the detail in relation to this particular relief. So just wind it forward. I'll come back or you will come back to example 1 shortly. But here are notes on the loss relief against total income. Right, as we have just said, may be relieved against total income after, as we made the point of a moment ago, any qualifying loan interest payments, in the unlikely circumstances indeed in a question that there are any, but after those, against total income of the tax year of the loss, i.e. the current tax year, and or the preceding tax year. The loss is calculated, remember, on an accounting period basis, i.e. we had an accounting period for us, the year ended 30th of June of 15. We'd have done our adjustment of profits, computed and deducted capital allowances, and the end result was a tax-adjusted trading loss. That put a nil assessment into the 15-16 tax year and gave rise now to the ability, if we so chose, to use that loss against the total income. And here, as per the example I've given you, a loss for the year ended 30th of June 15 against the total income of 15-16, the tax year of loss, the current tax year, and or 14-15, the preceding tax year. That is what we have just done. Now, remember what we said about the application of that loss. If the relief against total income is taken, whether it's current and or preceding tax year, it doesn't matter, whichever claim is made, the loss must be set off to the maximum possible extent, subject to a newly introduced cap on income tax reliefs. Now, there is going to be, again, it's unusual that this would ever have to be applied for most businesses, but there is a maximum amount of loss that may be used. There's a cap, a maximum that is applied in relation to these loss reliefs for the current and or the preceding tax years. But we'll see that in a few minutes' time. What did we say was the main potential problem of this? Personal allowances may therefore be lost, as total income, as we know, is before the deduction of the personal allowance. Partial claims are not allowed. Again, putting there in writing the words that I spoke a few moments ago. A claim against total income, as we know, may be made for either the tax year of the loss or the previous year, or both. You, the taxpayer, have total ownership over the claims that you make. You make the choice. Is it just the current year? Is it just the preceding year? Is it both? And if it's both, in what order will you make the claims? 2 years are treated separately, and a claim is required for each such year. They are 2 separate claims. Now, it is all well and good to be able to discuss what those loss reliefs are and how and where you may use them, but you may also have to show the application of those reliefs in the form of your answer. So what we may have is a working done like this. Now, you're going to use what we refer to as a columnar working. We're going to have a column for each tax year for our taxpayers' income. Now, what we've seen is the potential for carry back. So the 2 tax years that we were looking at were the current tax year, 15-16, the preceding tax year, 14-15, and remember, you may choose to claim against one or both of these years, but the loss that you may have may be bigger than either of or both of these 2 tax years, which may mean that irrespective of whatever claim or claims you make in the current and or preceding year, there's still loss left over, in which case that must be carried forward, as we saw earlier, and that would go to the next available tax year, 16-17. So what we have to do is to reproduce, it would be a fairly basic example, but reproduce the income tax computation for each year in columnar form. So we would firstly list out the trading income. Now what we know, of course, is in our example there was a loss of £40,000, back at the example I gave to you, a loss of £40,000 for the year ended 30th of June 15. What did that mean? The very first thing that we learned, that was a nil assessment in the 15-16 tax year. Now, of course, this particular business has been trading and continues to trade. So let's put some numbers in for what the earlier and future trading income figures may be. So let's say here that the previous year's trading income was £25,000 and next year's trading income, better news, is £50,000. So we'd made a relatively small profit in 14-15, 25. Things had got worse in 15-16 and we'd made a loss of 40,000, recall. 40,000 I gave to you. And then in 16-17, let's hope that this is a sign of better things to come, a tax-adjusted trading profit of 50,000. We have to reproduce what would be on the income tax computation. So having got trading income, again in terms of your layout, your format here to show these reliefs, leave a gap of 2 or 3 lines before then listing out any other income. Now any other income might, for example, be property income. It might be bank deposit interest. It might be dividend income. So we would now list out. Now these figures would be given to you. Again, in an example testing out the full income tax computation as per Chapter 2, you'd have to know the bases of assessment for each of these. Now I hope you do. We know that trading income has been assessed using CYB. Property income. What is the basis of assessment there? There we use an accruals basis. The rental income accrued less any allowable expenses incurred. Bank deposit interest. We looked at the amount received. And if it's bank deposit or building society interest, we recognise that that was received, remember, net. So we grossed it up. How? By 100 over 80. Dividends income. Again, we looked at the amount received and grossed it this time at 100 over 90. For what this time we recall was a 10% notional tax credit. Again, I hope we again remember those terms. So let's just put some numbers in here and see what we've got. Now this basically would be a copy down exercise from your exam question. Imagine that your exam question, and it probably would, lists out the tax years that I've done here in columnar form, and it gives you the various figures. The only difference was for trading income for 15-16, it would show the amount of loss. Remember, I gave you that number, £40,000 worth of loss. Okay, so we now put the other information in. Let's go with the current tax year first. So we're told that the property income accrued, that is £6,000. We've got some bank deposit interest. We've got there 1,000. That would, of course, have meant that the amount that we received was, well, you work it out, received times 100 over 80. Well, I think that's fairly obvious. You'd have been given bank deposit interest received 800 times 100 over 80 is £1,000. Dividends received. Let's say we received 900. So again, times 100 over 90 would give you £1,000. Now, what we know is that when we add together our earned and unearned income, we then get our total income. And here, of course, the total income for the current tax year would be £8,000. We then repeat this process for each of the other years, copying down, as I say, the information, the numbers from the question page into this answer page format. Again, I repeat, in this columnar format. So let's pick up the numbers. Let's say that last year's property income was 5,000. Last year's gross interest was 800. Last year's gross dividends were £500. So in which case, last year's total income, 5,000 plus 800, 58 plus 500 is 6,300. Add 6,300 to 25,000, the trading income, and that's going to be what? £31,300. £31,300. But check my mental arithmetic there, please. Same exercise for the next year. Let's say here we've got, again, 6,000, 1,000, 1,000, just for the sake of argument. And at this point, I'm not going to put the total in. Now again, we'll see why in a moment's time when we've applied the various loss reliefs. But I'm not going to put that in at this point. You'll see why, as I say, in a few moments' time. Right. Now remember the loss that we had. We had a loss of some £40,000. Now, in terms of how you answer an exam question, this is your main answer statement. In your answer booklets or on the computer, this is your main format of answering. A column for each tax year concerned. We obviously want the current tax year, 15-16, the preceding tax year, 14-15, and then the future tax year, 16-17. There will be future ones after that, but that will be sufficient for us and our needs. We put in the trading income figures, copy from the question, but simply put nil in instead of the loss. For us, we said, for our accounting year, a tax-adjusted trading loss of £40,000. Pick up and include on the relevant bases of assessment. The figures will probably be given to you. The only thing that might happen for the bank deposit interest, for the dividends, they might just say these are the amounts received and you therefore have to gross them up. What we also need, having got the total income for the current tax year and the preceding tax year, is on a separate page potentially, or certainly further on down this page, we're going to run a little working. Let's call it working 1, W1, and we do a loss memorandum working here. And into this loss memorandum, we place our loss. What was our period of loss? The accounting year end, 30th of June 15, in which we suggested, remember I made the number up, a loss of £40,000. And in this loss memo, we will show the different reliefs that are applied and the order in which they are applied. We'll also demonstrate that on our answer page. Right, so let's think what the reliefs available were. Set off against the total income of the current tax year and or the preceding tax year. Right, you've got a total income in the current tax year of £8,000. You've got a total income in the preceding year of £31,300. So question, do you think we will make any claim in the current tax year against that total income of £8,000, that £8,000 figure? Do you think it would be at all worthwhile to use 8,000 of our loss to remove that £8,000 income? Now I hope that you are saying no. The reason being, now again, leave 3 or 4 lines after total income, because after that you will deduct your personal allowance. And let's assume here the same level of personal allowance. They usually ask you to assume that the levels of allowances and tax rates for 15-16 applied in all other tax years as well. And our personal allowance is £10,600. So you just look at the current tax year. Do we have any taxable income at all as it stands? Do we have any taxable income for the current year? No, we don't. We already face the situation that our personal allowance of £10,600 there is bigger than our total income of £8,000. So we have nil taxable income and nil tax therefore to pay. There'll be no tax to pay, nil taxable income. So the last thing you're going to do is to come in with a loss relief at this point, and this is why I left the gap here, that the loss reliefs we're currently talking about go against total income of the current tax year and the preceding tax year. And not that you'd have to put in this, but in the current year, nil. You are not going to apply any relief. Remember, you had this flexibility, current tax year and or preceding tax year. Might we choose to make a claim in the preceding tax year? Yes, we might. Now, of course, there is still a price to pay. But now, looking at the preceding tax year, now, again, I want you to answer the question. Remember, we have available a loss of £40,000. So in the preceding tax year, what loss relief must now be applied if we choose to make that claim? Remember, you don't have to make either of these claims. That is up to you, current and or preceding tax year. But if you don't make any such claims, then the loss will simply be carried forward. You can't make partial claims. So on that basis, your claim in the current year must be let's put it, sorry. Your claim in the preceding tax year, I beg your pardon. Let's just scrub that out. The miracles again of modern technology. In the preceding tax year must be £31,300, which of course eliminates all of the total income for the preceding tax year, which means that your personal allowance will be wasted. Your personal allowance will be wasted. There is nothing to deduct it from there. Nothing to deduct it from. So, we have made no claim in the current year because the personal allowance of £10,600 is bigger than the total income of £8,000. We are paying no tax anyway. To make such a claim would be a waste of another £8,000 of your loss and save you no tax at all. In the preceding tax year, we face a similar problem, inasmuch as, given that we have a loss of £40,000, that is bigger than the total income of £31,300. So the only claim that can be made is that one, the full £31,300, which means that again, that personal allowance is wasted. But at least this time, we are taking out, eliminating all of last year's income figure, and we are therefore ensuring that we save what tax would have been paid in the previous year, because we've brought down our taxable income to nil. And we'll talk about how we might compute that tax saving, should you be required so to do, in a little while. But look at those two claims that are available. We could set off against the total income of the current tax year, 15/16, though to do so would of course be to waste all of the loss so used of £8,000. So we don't, and we therefore just deduct the personal allowance. It means we've still got some £2,600 of this personal allowance here wasted, but that's going to happen anyway, but we end up with nil taxable income. If we make the claim in the preceding tax year, then the loss is 40, the total income is 31,300, the claim is 31,300. It will eliminate all of our taxable income, but in so doing we will have wasted £10,600 worth of personal allowance. Right, let's just show how we'd have identified that on our loss memorandum. Remember, we had that other little loss memorandum. So, we have made no claim in the current tax year. We have then used in the preceding tax year. How much was it? I think it was £31,300. Yeah, £31,300. We've used £31,300. Well, we've used that out of 40,000. So that still leaves us with a loss remaining of, what's that going to be? £8,700. So we've made no claim in the current year, because to do so would be to waste £8,000 of our loss. We have made a preceding year claim of 31,300, leaving us with £8,700. Now, what is the only use then of that £8,700? That is to carry it forward. And when we carry it forward, what is it carried forward against? Only one thing, and that is future trading income of the same trade. So we carry forward from 15/16 into 16/17. Remember, I told you, after trading income, the first figure to go in, leave a few lines, and this is the reason why. Because this is where you will show the carry forward, for us here, the bringing forward of our trading loss. That will go against the next available trading profit. There it is, £50,000. Therefore, how much trading loss was available? I think that was £8,700. Take that away, and it leaves you with the net trading income for that year of, what's that going to be? £41,300. Remember also, when you set this information up from the question, I said there, don't put in any figure of total income, and this is why. Because if you had to carry any of this loss forward, as we have here, you were not going to include 50,000 as part of that total income, because you've got the loss here, 8,700 to go against it. So the income, the trading income net after loss relief is 41,300. So now we can put in our total income figure. Now that's 6 plus 1 plus 1 is another 8,000 onto 41,300. So that will leave us with what? £49,300 of total income. More than enough to absorb our personal allowance and still leave us with a substantial taxable income figure. How much would that be? Well, 10 from 49 would be 39. There's 600, so that's going to be, what, 38,700, I think. Again, just check my mental arithmetic there. 38,700, and you would proceed then to calculate the tax, if required, thereon. So look at our setup now. For each tax year, we put in, straight from the question, any trading income figures, remembering that where there is a loss, you use nil. Otherwise, copy in. If there is the possibility of a carry forward, leave a gap after trading income of 3 or 4 lines, into which then any brought forward loss may be shown, such as you see here, for the 16/17 tax year. Then list out any and all other amounts of income that we may have. Now, you probably won't have as many as I have included there. That's all the main other types of investment income that you might see, whether it's property income, interest income, or dividend income, and include, usually, as I said, a straight copy down from the question here onto your answer page. Get your total income figures for the current tax year. They're 8,000, and the preceding tax year. Just leave that total there for the following year empty until you know how much, if any, of the current year's loss may go forward against the trading income figure of that year. We will then explain what the available options are. The available options are, if you want a more immediate relief, set off against the total income of the current tax year, £8,000, and or preceding tax year, 31,300. Any balance of loss left over, carry forward against future trading profits of the same trade, for us the £50,000 there. What then may we choose to do? Well, absolutely no point making a claim in the current year because it would save not a penny in terms of taxation. So that therefore would waste the personal allowance. So no claim. Again, we'll put a note to explain these reliefs and our reasons for claiming or not claiming. So far as the preceding year is concerned, if you make the claim, it will be $31,300. Again, though sadly, that will result in a wastage of the personal allowance. On your loss memorandum, you keep a check of that. Preceding tax year, $31,300, leaving $8,700. What do we then do with that? That was carried forward to the 16-17 tax year, where all $8,700 was used, and that of course was against trading profit. So your loss memorandum is complete. Your working page is complete in as much as take away the 8,700, get your remaining trading income, add in the other amounts of income there, and going the wrong way. And you have got your total income. Take away your personal allowance, you've got your taxable income figures. Now what I'd like you to do is to pause and review through what we have done there. Maybe again go back over any of that you need to, any of this lecture so far. Make sure that you're happy with what we have done. So you review through, pause this, and then come back and join us. Okay, well, when you're happy with the exercises that we've done and the issues that we have referred to, again, go back to your notes there. But between now and our next lecture together, I'd like you to work both examples 1 and example 2 there in chapter 7, example 1 and example 2. Thoroughly review through the answer, make sure that you're happy with that. And then once done, again, join us again for our next lecture dealing with these loss reliefs.